Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media, like I normally do. It's generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll interject my financial opinions as we go through it. If you want to follow me, it's @_finance, and if you want to join our community, finding-value.com. Again, I dive deeper into all these sectors, topics, looking for potential investment opportunities and sharing that with everyone. I also share much more than that: technical analysis, fundamental analysis, training sessions. There's a lot of stuff that I have on the website that can help you that I have performed. You can also ask me questions during the weekend, and I can answer your guys' questions if you have any questions. So we've got Casper here, XLK, which is technology breaking down versus energy. Yeah, this is a bull market, guys, and we're going to resume the outperformance, perhaps, of energy outperforming technology. This is a big deal. What this is signaling is money flows, and we're seeing a lot of money flow into the commodity sector, specifically precious metals, which is the leader. And now we're starting to see it flow into other sectors like energy, fertilizers, copper, all over the place. It's all over the place. It's going and spilling into all these different commodity areas. What this spells is outperformance. Outperformance. We got Nick here. It says the law of unintended consequences. The politically driven desire for cheap oil will ultimately have the exact opposite effect. It says, look, oil is being driven down by financial repression, no other reason. I agree. It is. You can see it in the chart if you know how to read a lot of charts. You can also look at commercial inventories, which we're going to look at in a little bit here, and what the undervaluation is compared to history, the dot plot. And we are over 2 standard deviations away from fair value. So these events do occur, but people are positioning in oil. I don't know if they're doing it on purpose, where they financially repress oil, talk about $50 oil, and then all their buddies start to buy up all the oil equities. I'm seeing a lot of buying pressure in the oil equities. Now, does that mean that we go up in a straight shot? It does not mean that. You still need to be emotionally stable, still need to execute strategies and just, have fun with the ride, wherever the ride takes us. Nostro House of Gold says, who's ready for $4,000 gold? Well, a lot of people, I am so patient that I'm kind of indifferent if my account goes up or down. My indifference is what makes me good, in my opinion. So I used to be much more emotional on up days and down days. Now I'm kind of steady Eddie, just a steady Eddie dude looking at the portfolio. And if it goes way down, I'm like, well, I'm going to buy a bunch more. If it goes way up, that's great. My account value goes up. But, what's the end game of this? The end game is really never having to work for someone else again. That's my end game. And my goal, you get over, I would say, a couple $1 million. You get over a couple $1 million, that's probably good enough for most people. I'm not out here trying to buy Ferraris or Lamborghinis. I'm not doing the Wen Lambo. I don't even want those cars, to be honest, guys. Even if they were given to me, I don't want them. I don't want the maintenance. I don't want the high part cost. A lot of them are not that reliable anyway. So, I'm a Mazda, Honda, like basically that type of guy that I would go and take the car to the track and have some fun. If some parts break, you get some cheap parts, you throw it back together. There's nothing more fun than just driving any car with a high revving engine to just rip on it. It's so much fun. Anyway, I know it's a little off topic, but $4,000 gold, yeah, it's coming. I'm sure we're going to beat $4,000 gold in this bull market. Silver's probably just going to rip like heck. I'm positioned for all of it. So if it goes now, I'm ready. If it doesn't go and it goes out in the future, then I'll buy some more maybe of some stuff that's down. That's kind of my view. I'm kind of indifferent. NVIDIA CEO, every single data center in the future will be power limited. We are now a power limited industry. Well, that's good for energy investors because that's where I'm invested. If you're power limited, that means that we need a lot more power. And if we need a lot more power, what generally happens? When there's a shortage of power, the price of power goes up. So if they're limited, I'm okay with that. I'm investing in energy. Smart real estate bets and boring businesses. I wanted to talk about this a little bit. I know it's not 100% related with investing, but it is business related. So what this guy says, he says, underrated career advice is recognizing that you don't work for your company's CEO or the head of your group. You work for the person who sits directly above you in rank. Always make them look good in front of their boss. The promotions and pay raises will naturally follow. That's pretty good advice. I wouldn't say it's 100% accurate, but it's pretty good. What I would say is even deeper than that. So let's just say I was a manufacturing engineer by trade. That's what I got my degree in from college. If you want to do well as a manufacturing engineer, you need to look at the company and evaluate the company as a whole in itself. So this is the most important thing, in my opinion. You need a company that rewards merit. And if it rewards merit, merit is merit-based compensation and merit-based promotions. If it's merit-based, you also want to look at what they make and how much control you have over what they make. So if you're a manufacturing engineer and everything's built by hand, and it depends on how good the builders and assemblers are, and there are things that you can do to increase the robustness of the design to make it easier to build, but there are some designs that will never really get that much better. So no matter how good you are, you're hostage to how well the design is. And then you have to pair that off with your boss and then your boss's boss to see, number one, how well and how fast they promote people. Because if the company itself doesn't really promote people and it's not merit-based, you might as well just leave. If you're working on very difficult designs where they're incredibly hard to make and there's no wiggle room in tolerances, and you're going to inevitably scrap things, and that could be against everyone who's in that group, or maybe you're working on more difficult products. That's something outside of your control. There are other businesses and other industries that are more make a widget, and you can make them very quickly by capital expenditures and other things. And that is very easy if you're in an environment where they give promotions, a lot of promotions, and you have more control over the outcome. So you can be really, really good, and your boss assigns you crappy projects. You can do as good as you want, and let's say you outperform, even outperforming everyone else, and he still may not give you a promotion because there just isn't any in the budget, or the company doesn't really promote that often. That's a company thing versus a boss thing. Now, it's always good to make your boss look good. I agree with that. But I also think it's very important that your boss wants to promote you and that you need to get in there and tell your boss that you want to be promoted. So it's a combination of all of those things put together. Some of my root cause analysis training that I've done, a lot of it deals with conditions. You have actions and you have conditions. If you break those two up, what you want to do is you want to put yourself under very favorable conditions, and then you can add your actions that you have control over. If you're in a crappy company, in a crappy industry, with a crappy boss, that's a bad market condition for you, or a bad condition to operate under. If you're in an incredibly good industry that's growing rapidly, in a good company that is progressing quickly, strong revenues and growth, they are promoting people left and right, and you have a favorable boss, That's the best of all worlds. So I will tell you this: the most important thing is the sector and the company that you work for. If you work for a company that doesn't make a lot of revenue growth and profits, you're not going to get a lot of raises. It's just the way it is. Coming down, Kevin Bambrell says, sometimes it's difficult to tame my greed. Rebalancing your portfolio is a great way to counteract the difficulties with controlling FOMO. Sometimes you need to be able or be happy about massive gains you've had and be comfortable taking profits, even if it means letting some stocks run away for a while. Stocks like, I don't know what EDR is, but are great for teaching this lesson. It's amazing how they explode higher over and over again, but then drop in dramatic fashion at times. Sell your joy, buy your pain. Learn to overcome fear and build good trading habits by keeping position sizes small at first so you can stick to a plan. Remember, if you don't follow your plan, you don't have a plan. You likely lack discipline and will get crushed at some point. What I do is, let's look at EDR real quick. So here's EDR that he talked about. Let's just take a quick look at it together. So Endeavor Group Holdings, and it looks like you have a big wick at the top here. It's generally a bearish move, and then it reversed lower, and this still maybe could go lower. I don't know this company. But a lot of people on Twitter, they seem to trade. What I want to do is I want to capture a bottom and then stick it an entire commodity bull market. So we'll go back to my favorite SM Energy. I'm not here for small money. I'm here for big money. So the big money here, if you purchased it in 99, 98, you got your entry point here. And if there's some way that I could hold through and be good to maybe sell it here, or maybe here, or maybe even here, anywhere around here, it doesn't really matter. Somewhere in that upper area. And then I purchased it down here. So this would be a run from about $4 and selling it about $70. Well over a 10 bagger. That's what my goal is. And I'll just hold and ride through all this crap. If I can do that. That is what I want to do. I'm not really interested in trying to trade and do short-term things. I don't know anybody who's made a lot of money trading. I just don't know anyone. So, I'm not trying to capture these small market moves in there. So that's my approach. And there's many things that I use to establish good entry points. Good entry points could be a cheap ratio, a good technical pattern, and the sector starting to turn around. And then I go long, and then I go long for years. I play the entire bull market. The big money is made in sizing up the big move. So a lot of these guys, what happens is they try to time the short term, and they get kicked out. They get chewed up, and they don't make any money out of it. They don't make any real money out of it. I'm not saying Kevin doesn't, but I'm just saying other people who trade, they don't make a lot of money. They make a 20% here, 30% here. They have a bunch of losses. They really end up making no money. When you focus all of your effort and all of your not just effort, but all of your brain power, it's better to kind of like silo it. So the problem with trading, if you're going to do it, is you've got a lot of questions that you have to answer. A lot. Should I, buy it down here, and then do I sell it on this pullback there, or do I sell it here, or do I sell it here, or do I sell it here? You're asking yourself every single day, should I sell? Should I sell? Should I sell? If you play the big bull market, you get good entry points, and all you're looking for are good entry points. You take away, I need to sell this thing every single day. And then you look at the driving factors behind this, which basically led to here. If somewhere in here would have been probably my selling point, all through this area, maybe in here. So probably about $40, and we entry point it'd be about a 10 bagger, most likely. And I don't know if I would have caught this top there, because when the real estate market goes, that's generally when you want to exit. And that's when the real estate market went. It came back down, and then it bounced and came back up again in your ultimate top there. But that's you can focus your efforts on buying, accumulating, and then looking for the overvaluation and the sell point. Oil was overvalued here, and it would have been a great time to offload everything. So I think there's a high probability that that would have been an 8 to 10x during that time frame, and a high probability of offloading it into that. I think we're coming into the same market conditions. So I'm not saying that timing the short term is impossible, but I can tell you it's really hard. And it's way harder to make way less money than doing the methods that I do. So that's what my opinion is, and what I've found trading. I used to trade in the past, get really good entry points, make 20, 30, 40, 50, 100% moves, and then sell it. Now I'm much more of a long-term holder, and I make way more money doing it. It's also easier because when you trade, you have to find all these ideas, and you have to find new things, and you have to look at position sizing, and you never can deploy kind of all your money. If you play the big bull market, you can deploy a lot more capital in a lot of better areas, in my opinion. Warning, fund managers just rotated out of the United States stocks at the fastest pace in history for March of 2025 here. A big move from December 24 to March 25. Are we going to continue to have this rotation? We'll have to wait and see. And this is kind of what I'm playing. I'm playing the bull market from 01 to 08, which is over here. That's your money rotation coming into it. And then you can see the vast move in 08 all the way to November of 08. So we're getting that money rotation similar to August 01 back into early here. So that's good. It's money rotating into other areas. Process wins over intuition every time, says David Burrows. And this guy says 10 dangerous trading sins. Removing your stop loss, chasing extended stocks late, buying a rumor, moving a stop loss lower, adding to a position before earnings, averaging down in a losing trade, random trades, shorting volatility after it's expanding, big position sizes in biotech, shorting momentum stocks in an uptrend. I don't really trade. So what I'll say to this is I don't use stop losses. I buy value, and my cover is the value difference between the price and the value of the business. And then I look at larger cycles behind the business to push the business forward. This here is all you're playing the psychology of the herd is what you're playing. And that's all what these chart patterns are on shorter time frames. You can get blown up no matter what. I mean, what happens with most of this, if you go after highly volatile stocks, you won't bottom pick. So getting within like 6% of the bottom is really difficult. And what happens is you'll just get stopped out on everything. If you take a couple positions or a couple of buy points and you cost average into the position, that's kind of how my approach is. And then I ride the stock up with all the tailwinds behind me. My investing is completely different than this because, in my opinion, these guys don't make any money. So no matter how good this guy is and what this is, very few make a lot of money. Very, very few. And I would say hardly anybody does. But the process does win. Your strategy and your process. So what I would say is what I've come to the conclusion of looking at all these different strategies and processes is portfolio position size is important to protect against losses. That is your stop loss, is your position size. Patience is important if you're playing the game. Value is important. And then you have to make sure that if you are going to invest in commodities, that you're in cycle. That's what's important. If you're in cycle, you're undervalued from like a price to book or price to net asset value, something like that. That's where you can outperform. And you have to wait for the conditions to change, for money flows to change into where you're at. So it takes time. A lot of people say, well, I don't want to wait. They would rather trade and lose money. I'm like, okay, then go lose money. That's what your options are. The game taught me the game, and I am a function of the game. Now, does that mean that I play the game better than everyone else? I'd like to think so, but there's a lot I can improve upon. Still, there's a lot I can improve upon, and I'm getting better and better and better and better. I'm refining my strategies, my process, and I'm getting a lot better. At some point, I will be lethal, absolutely lethal. And I never saw the beginning of the commodity bull market. I didn't experience it that first time. I came towards the back end of the commodity bull market into investing. Call it 2005, 6, 7, that time frame. But I'm seeing this beginning of the bull market, and I think I'm understanding exactly how these cycles play out as I live through it. And I'm documenting, not writing it down, but I'm documenting it in my head and my experience. You can also go back and look at the beginning of 2009, which is a different cycle for technology stocks in the S&P 500. You can look at how they behaved. So you can look at and go back to the beginning of some of these markets, and you can see that they chopped in the beginning here. So your ultimate bottom was 2009 of that cycle. But we had lots of choppiness in the beginning. People were in the disbelief phase. They didn't believe in this bull market. And then finally, when they started to break out of everything, we had a very big move. And that's kind of what I'm doing. So when the cycle ends, you get a choppiness period here. That's your chop. We're going through the chop and exiting the chop right now in commodities. And eventually we're going to get this. That's what's coming. So we're in it. It's good. We're getting through it. And I think we're going to have a big move out in the future. So here's Kevin. He says, I believe the bottom is in for URNJ and URNM. They are now beginning inflows. It will drive the U.UN, which is the Sprott Physical Uranium Trust, higher and take it from a minus 10% discount to a premium. This process has happened over and over again since these vehicles become so intertwined a few years ago. And SPUT put ATM at the market stock issuance in place. As soon as it moves back to a premium, it will chase the uranium price higher. Utilities watch SPUT and don't want it to accumulate additional pounds. The result will be a ramp higher in the spot price, which will excite uranium investors. They will pour more capital into URNM and URNJ and other individual uranium equities. There is currency terrible sentiment in the space. This always marks a bottom. I think most stocks can easily rally 35 to 50% or more with little headway. 20 to 25% levels seem to me to be a layup. The long-term fundamentals are solid as a rock. Uranium trades based on 5 to 10 year out projections and is highly subjected to emotional sector. The reality is the world is going to move to nuclear power in a huge way. Stockpiling uranium provides national security. I see an overall trend in place to flee U.S.-denominated bonds, U.S. dollar bonds, and own something real. Totally agree with that. For many nations with long-term nuclear power ambitions, purchasing uranium is a good solution considering the value to storage cost ratio, plus your stockpiling energy. It's the opposite of foolish in spending dollars to mine bitcoins, which destroys energy and leaves you with a token that is a nothing more than a monument to the stupidity of today. Zero intrinsic value. I like how he added that at the end. He's right. We're going to move to nuclear in a very big way. We have to. There is no other alternative. Nuclear is going to be a huge part of the future. As fossil fuels start to peak out over the next 5 to 10 years, nuclear is going to be adopted in record pace. So we're at the bottom of this bull market in commodities for this pullback, I think. And I agree with him. And there are a couple good investment companies, I think, that are going to do very well in this commodity bull market in uranium. So I've loaded up in them. I'm in them. I'm going to ride this thing with Kevin here. Willem says, history never repeats. So this is silver, continuous contract, moving on up. It looks fantastic for silver. We've got Ross J. Brown. He says, an integrated oil and gas company, Chevron, CVX, is working its way out of this 3-year consolidation pattern. It's breaking to the upside. This is not what you see if oil is going to be $50 a barrel. This is what you see when people are positioning in front of the move of oil. Chevron, ConocoPhillips, ExxonMobil, they're all sitting on top of patterns breaking to the upside. XLE is another one. We can look at XLE. XLE is basically ready to try to break to the upside here. We're squeezing up here, ready for a big breakout to the upside. So that's not what a bearish market looks like. Another thing that we can also look at is this consolidation happened in 2000, 2001. That's the consolidation, and we're going to start wave 3 here. It's going to be a big move, a very big move. And I'm positioned for all of this. I went through and fine-tooth combed what I think I found the 5-6 best companies in the world to play this with. No, it's not going to be Chevron. Chevron is a large company. They are going to struggle to grow production. They're still going to go up in price, but I don't think they're going to perform at all like some of the companies that are in the portfolio that I've got on the website there. I don't think there's a chance. So I am upping my what I do is it's not really upping risk. It's more of I'm upping the leverage that the company has on the balance sheet. It doesn't mean that they've got debt, even though some of them do have debt. It's high-cost producers provide more leverage than low-cost producers. The low-cost producers are all these big companies. They're going to struggle to find production growth. So what I'm doing is I'm in the smaller companies, small to mid-cap companies that I think are just going to rip. I mean, they're going to rip with oil going above $100 a barrel. They already have upside momentum. They've got great looking chart patterns. The technicals are solid. The fundamentals are solid. They're buying back shares. Some of them are paying dividends. And we're starting to break out on the big boys here. That's the beginning move. The beginning move is already initiated here. And we can go and look at some of the lagging companies that are still cheap and buy them up. That's what I'm doing. Energy service companies are also at incredibly good opportunities here. 2 sigmas below historical relationship. So total commercial inventory ex other oils, it was down 6 million barrels week over week. Implied WTI fair value price of $92 or $25 undervalued from current market price. Commercial inventory excluding other oils at a 2.5-year low and the lowest print since November 2022. There's our 2 sigma. What does this mean? So this is your fair value, the dark line here, and you want to go straight up to fair value. That's $92, roughly speaking. So we are undervalued given where inventory levels are at by $25 a barrel. Have I been buying a bunch of oil? Yes, I have. I've been buying the crap out of it. Now, some people say, oh, what about the recession, the $50 oil? What about drill, baby, drill? What about Trump? No, that's not how I look at it. I look at value and I look at the data. This is the data. I can put on a bet where we're $25 undervalued in relationship to commercial inventories. We've got seasonality coming into play, positively impacting oil to the upside. That's in check. We're at a 40, I don't even know what we're at right now, 40-something dollar per barrel. So this is 1 ounce gold. We're at 45.6, almost 46. Guys, oil is cheap as get out. I'm ready for this. So yeah, I'm going to buy it. Everything's in alignment on valuation of oil being cheap to gold. Oil just recently broke out against the S&P 500. There's your breakout here. And then we've got a small pullback. This is going to outperform in this double bottom. Oil is going to outperform the S&P 500 financial assets. It's all in alignment here. It looks fantastic. So yeah, I'm buying the living crap out of oil. And I should say I've already done it. The equities and all that stuff. I'm already positioned. I think a lot of the companies bottomed probably about a week or 2 ago. EIA inventory moves. We've got crude up 1.7, and then we've got a lot of, inventory draws for gasoline, distillates. It's all the final products. We got Valaris here. It says this cash flow inflection is yet to come for both Valaris and the offshore drilling industry. So that's one company that this guy is sharing. And yes, the offshore is about to go ballistic out in the future here. it's going to look fantastic. And cash flows are going to be oozing everywhere in the offshore drilling space. Ray Dalio has said that a severe U.S. supply-demand problem could lead to shocking developments. The U.S. has to sell a quantity of debt that the world is not going to want to buy. He said this was imminent and of paramount importance. So they're trying to lower interest rates to offload all this debt. The problem is there's so much debt that nobody wants to buy. It wants to increase the interest rate. That's the problem. And when interest rates go up, the stock market goes down based off of net present value calculations. It also can increase the rotation of money into hard assets and precious metals. And that's the whole rotation. It's all right there. And we've got a big problem here. Big problem. Here's Alberta AECO gas prices moving on up. It looks good. For AECO, it's up over $2.25. That's good for natural gas producers in Canada. Freight futures AM, we got dry bulk is down, Capesize and Panamax 2% and 1% respectively. And then we've got tankers, VLCC up 1%, Suezmax flat. We've got those refusing to invest in Sibanye just don't understand how incredibly compelling the mean reversion of platinum to gold is. Well, some people like walking past $20 bills on the ground. Gold to platinum ratio, look how high that is compared to the history. We are incredibly cheap for platinum. Platinum it's an anomaly, guys. It's an anomaly for platinum. David Burrows says, when it starts, it rarely ends after 1 month. The marginal buyer of U.S. equities is choosing alternative assets. Too early to swim against this current record rotation out of U.S. stocks. I shared that earlier too. And that's where we're going to end it, guys. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We've got a Sunday question and answer session coming up at 5 p.m. Mountain Time. Specials, coupon code if you'd like to join and try it out. 50% off the monthly membership and a larger discount on the yearly. And if you're in a monthly, you can always switch to the yearly whenever you'd like. But that's all I've got for today. We'll catch you next time. This is Finding Value.